West Edge here. The Federal Reserve just made a move that changes everything for silver, and no one's talking about it. Yesterday, the Fed released internal documents showing they've been tracking physical silver flows for the past 18 months. Not paper, not futures, physical metal. The same metal that's disappearing from vaults across 3 continents right now. Let me show you exactly what's happening and why this matters for your portfolio. Current prices, as I'm recording: Western silver spot sitting at $32.47, gold at $3,187. The gold to silver ratio just hit 101. That's not normal. That's historically extreme. The last time we saw ratios above 100, silver exploded 400% in the following 18 months. But here's what most people miss. The ratio isn't just a number, it's a signal. And right now that signal is screaming. Let me break down what the Fed documents actually reveal. According to internal memos obtained through FOIA requests, Federal Reserve analysts have been monitoring what they call unprecedented physical demand anomalies in the silver market since January 2023. These are not conspiracy theories. These are government documents. They specifically note that industrial demand for silver has exceeded mining supply for 4 consecutive years. 4 years, not months, years. And the deficit is accelerating. The numbers are staggering. 2022 deficit was 237 million ounces. 2023 hit 184 million. 2024 came in at 215 million. And preliminary data for 2025 suggests we're tracking toward 250 million ounces or more. Where does that silver come from? It comes from stockpiles, from vaults, from the reserves that were supposed to last decades. Those reserves are disappearing. Now here's where it gets interesting. While the Fed tracks these flows internally, publicly they say nothing. Silence. But their actions tell a different story. 3 weeks ago, the Fed coordinated with Treasury to modify reporting requirements for precious metals dealers. Starting next quarter, any transaction over $5,000 requires enhanced documentation. Why would they do that if they weren't concerned about physical flows? They wouldn't. Before we go further, I want to address something. I've received dozens of messages asking about the technical setup I mentioned in the last video. I said, watch the 28 to 30 zone as support. Price tested 28.40 and bounced hard. We're now back above 32. If you want me to break down these technicals more frequently, drop a comment below with West Edge and let me know. For long-term physical stackers, remember, these price swings are noise. The fundamentals haven't changed. But if you're trading paper, risk management isn't optional. It's survival. Let's talk about what's happening in India right now. The Mumbai Bullion Association just reported that silver imports for March exceeded 3,000 metric tons. That's triple the monthly average from 2023. India isn't just buying silver, they're hoarding it. And here's the critical detail. This silver isn't going into jewelry production, it's going into private vaults. Wealthy Indian families are converting rupee holdings into physical metal at rates not seen since the 1970s gold rush. But India isn't alone. China increased silver imports 47% year over year. Mexico, despite being the world's largest producer, is now importing silver for domestic industrial use. Think about that. The largest silver producing nation on earth can't meet its own demand. That's not a temporary imbalance. That's a structural crisis. Meanwhile, the paper market tells a completely different story. COMEX registered silver inventory shows 285 million ounces available for delivery. Sounds like a lot, right? It's not. That inventory would cover global industrial demand for approximately 45 days. 45 days between modern civilization and silver shortage. And here's what the mainstream won't tell you. That registered inventory has declined 38% since 2021. It's not growing, it's shrinking. Let me explain why this matters for price discovery. When physical inventory tightens, the paper market should reflect that reality through higher prices, basic supply and demand. But we're not seeing that correlation. Paper prices remain suppressed while physical premiums explode. That's not a free market. That's manipulation. And the evidence is everywhere if you know where to look. The Shanghai Futures Exchange silver contract is currently trading at 14% premium to COMEX. 14% for the same metal. That arbitrage shouldn't exist in efficient markets. But it persists because physical silver can't move fast enough to close the gap. Dealers in Hong Kong report 8 to 12-week delivery delays on standard orders. London Metal Exchange warehouses showed declining inventory for 11 consecutive months. Now let's connect this to the bigger picture. The dollar just experienced its worst quarterly performance since 2017. The DXY dropped from 106 to 99 in 3 months. That's a 7% decline in the world's reserve currency. Where does capital flow when the dollar weakens? Historically, into hard assets. Gold, silver, commodities, real things that can't be printed. Treasury Secretary Bessent made a remarkable statement last week. He acknowledged publicly that the dollar's reserve status faces challenges from alternative settlement systems. That's diplomatic language for admitting that the BRICS coalition is making progress on their de-dollarization agenda. Russia just settled $280 billion in trade using non-dollar currencies last year. China's yuan is now used in 31% of global trade transactions, up from 12% 5 years ago. What does this have to do with silver? Everything. Silver isn't just a precious metal, it's an industrial necessity. Solar panels require silver. Electric vehicles require silver. Smartphones require silver. Medical devices require silver. Military systems require silver. Every technology that will define the next century requires silver, and there isn't enough of it. Global silver production peaked in 2016 at 900 million ounces. Last year's production came in at 820 million ounces. That's a 9% decline, while demand increased 23%. Mining companies aren't investing in new production because prices have been artificially suppressed for a decade. It takes 7 to 12 years to bring a new silver mine into production. Even if prices doubled tomorrow, the supply response would not materialize until 2035. We're locked into structural deficit for at least another decade. Here's what the smart money is doing. Eric Sprott increased his silver position by $40 million last quarter. First, Majestic Silver just bought back 12% of its outstanding shares. Keith Neumeyer has stated publicly that silver is more undervalued today than at any point in his 4 decades in the mining industry. These aren't speculators. These are industry veterans with billions in skin in the game. But the narrative war continues. Every time silver approaches key resistance levels, coordinated selling appears in the futures market. It happens with mathematical precision. Last month, someone dumped $500 million worth of paper silver in a 15-minute window during low liquidity Asian trading. The price dropped 6%. But here's what's fascinating. Physical buying increased the next day. The paper smash triggered panic in futures, but physical buyers saw a gift and stepped in. The CFTC Bank Participation Report tells the story. 4 or fewer U.S. banks hold 38% of all commercial net short positions in silver. 4 banks, controlling nearly 40% of the short side. That's not a market. That's a cartel. And their position is now larger than at any point since the 2011 silver run to $50. Let me explain why that matters. In 2011, silver ran from 17 to 49 in 8 months. The commercials were short the entire move. They lost billions on paper but never covered. They simply held positions through margin increases and waited for retail traders to capitulate. Then they crashed the price back to 14 over the next 3 years. The question is whether they can repeat that playbook today. I don't think they can. Here's why. In 2011, the silver market was dominated by speculative demand. Paper traders chasing momentum. Today's demand is fundamentally different. It's industrial, it's sovereign, it's physical. China isn't going to capitulate on their solar panel production because paper prices drop. India isn't going to stop importing silver because COMEX shows weakness. The physical demand is structural and it's not going away. The energy transition requires 1.5 billion ounces of silver over the next decade for solar panels alone. Current annual supply is 820 million ounces, total, for all uses. Jewelry, investment, photography, electronics, medical, and solar. There simply isn't enough silver to meet projected demand at current prices. Something has to give. Now, let's talk about what's happening in the mining sector. Silver miners are facing input cost inflation of 12% annually, while silver prices remain range-bound. That's unsustainable. Core Mining just suspended development at their Rochester project, citing economic uncertainty. First Majestic reduced 2025 production guidance by 15%. Hecla reported higher costs and lower output last quarter. The majors are struggling, but the juniors are dying. Exploration budgets have been slashed, new discoveries are declining. The average grade of silver deposits being mined has fallen from 300 grams per ton in 2000 to 180 grams per ton today. We're mining lower quality ore because the high-grade deposits are exhausted. That means higher costs per ounce at a time when prices don't support expansion. This is the paradox. We need more silver production to meet industrial demand, but prices are too low to incentivize production, and manipulation keeps prices too low. So the deficit grows, inventories shrink, and one day the physical market will simply overwhelm the paper market. That's not speculation, that's math. The question is timing. And that's where the current setup becomes interesting. COMEX delivery notices for March totaled 47 million ounces. That's the highest March on record. Someone is standing for delivery instead of rolling contracts. That's unusual. Paper traders typically roll positions to avoid taking metal, but increasingly, entities are demanding physical delivery. JP Morgan stopped 23 million ounces in March alone. They're accumulating physical metal while the rest of the market shorts paper. Think about that. The largest silver short holder is simultaneously acquiring physical metal. They're positioning for the very squeeze that their paper position would lose from. Either they're hedging or they know something about timing that we don't. Here's my read on the current situation. We're in a consolidation phase following the run from $22 to $35. The paper market is working to shake out leveraged longs. Volatility will remain elevated. Short-term price action is unpredictable, but the fundamental setup continues to tighten. For physical stackers, this is accumulation territory. Every ounce you add at these prices will look brilliant in retrospect. The supply deficit isn't going away. Industrial demand is accelerating. Monetary demand is increasing as faith in fiat currencies erodes. The setup is generational. For paper traders, extreme caution is warranted. Use stops, manage position sizing. Don't let these markets take you out before the move happens. I've seen too many people get the thesis right and the execution wrong. Being early and wrong is functionally the same as being wrong. 3 takeaways from today's analysis. 1. Federal Reserve internal documents confirm they're tracking physical silver flow anomalies. This isn't speculation, it's documented. The Fed sees what we see but won't say it publicly. Their policy actions speak louder than their silence. Enhanced reporting requirements for precious metals dealers. Coordination with Treasury on monitoring physical flows. They're preparing for something. 2. Physical demand is overwhelming supply across every major market simultaneously. India imports tripled. China up 47%. Mexico now importing, despite being largest producer. COMEX inventory down 38% since 2021. Shanghai premium at 14%. Delivery delays extending globally. The physical market is separating from paper pricing. 3. The mining sector cannot respond to increased demand for at least a decade. Exploration budgets slashed, major projects suspended, ore grades declining. Cost inflation at 12% annually. Even if prices doubled, new supply wouldn't arrive until mid-2030s. The deficit is structural and locked in. Unresolved question for future analysis. How long can paper manipulation continue when physical inventory approaches critical thresholds? COMEX registered inventory at 285 million ounces. Industrial demand consuming 820 million annually. Investment demand adding another 200 million. At current depletion rates, registered inventory covers less than 6 months of demand. What happens when the buffer disappears? The tension between paper pricing and physical reality cannot persist indefinitely. Every ounce leaving registered inventory is one less ounce available to defend paper short positions. At some point, a major industrial user or sovereign buyer will attempt to take delivery of more metal than exists. That's when the paper market breaks. Some analysts suggest this happens in 2025. Others say 2027, and no one knows the exact timing. But the setup is clear, and it's accelerating. Do your due diligence. Understand the risks. Paper markets can remain irrational longer than you can remain solvent. Leverage is dangerous in volatile conditions. Position sizing matters more than conviction. But for those with patience and proper risk management, the current setup represents one of the most asymmetric opportunities in decades. The fundamentals support dramatically higher prices. The physical market confirms scarcity. Central banks are positioning. Industrial consumers are hoarding. And paper prices remain suppressed by concentrated short positions that grow more vulnerable with each passing month. Know which time frame you're operating in. Invest with logic, not emotion. Use your own brain. Don't follow anyone blindly. Not me, not anyone. Do the research, verify the data, draw your own conclusions. This is West Edge. See you in the next one.